after the Fed announced a couple of weeks ago that in 2024 they plan on doing at least 3 rate cuts throughout the year. A lot of people are celebrating, especially the stock market, and thinking that this is just going to be the best thing ever, and 2024 is going to be the year that things just shoot to the moon. However, there's a lot of things that can happen between now and then that we need to look out for, that a lot of people just are not talking about, because they think that, well, just because they're going to cut interest rates, that everything's going to be fine, guys. Well, that is not actually the case. There's actually a lot of pitfalls we have to look out for in 2024. One of the big ones is actually resurging inflation, because the Fed did say that inflation is still too high. It's not like this whole thing is over with. There are some things that can keep inflation higher for longer, which we'll talk about later in this video, but it is something that typically happens whenever inflation starts coming down. It ends up going back up, especially if they give up on the fight on inflation a little prematurely. Inflation can easily start heading back in the wrong direction. Something else we got to look out for in 2024 is slowing economic growth, okay? In the third quarter of 2023, we had a 4.9% year-over-year increase in GDP. But it's being predicted that in 2024, these GDP numbers are going to come to a screeching halt, essentially. And that's not going to be good timing, because right now we already have gross domestic income going down, which is GDI, and then if we see GDP fall in 2024, it's going to be bad news for the economy is what it's going to be, because that's going to mean less jobs, less people out there working and spending money, and ultimately it's bad news for the economy, guys. And one thing that we just started to feel in 2023 that's likely to continue into 2024 is tight credit conditions. Because in October, about a third of banks reported tightening credit lending standards for companies with less than $50 million in annual sales. So once again, it's small businesses that are being hurt by this the most right now. And the small business is the lifeblood of the economy, guys. The small businesses employ the majority of people throughout the country. And if small businesses is hurting, what are they going to do? They are going to cut back on staff. That is just a natural way of things. Here we have a house for sale that's actually under contract, but before you get too excited, they've been trying to sell this house for 1.5 years, since July of 2022. They bought it back in 2017 for $500,000, tried listing it for sale for $1.3 million, lots of price cuts later, and only now that they got the house under contract 1.5 years later, guys. It's kind of amazing how out of touch with reality a lot of these sellers are, and their property tax bill is about $18,500 per year. And to give you an idea how much this small business lending is slowing down, last month, in November, only 13% of small businesses that applied for a loan actually received the loan. That should give you an idea of how much the lending is pulling back right now. And if businesses can't get access to credit, it can cause all sorts of problems. It can cause problems with inventory. It can cause problems with payroll. It can cause problems with keeping their employees, guys. Another major headwind that's coming for the economy that we also have only just begun to feel in 2023 is a giant commercial real estate crash. You know, you can argue all day long that the residential housing market is still strong, but there is no case to argue that commercial real estate is holding up, because we have seen the values of commercial real estate absolutely plummet in 2023. That trend is going to continue into 2024, because essentially these high interest rates are crushing commercial real estate. Because of how often it needs to be refinanced, these buildings and the value of them are dropping like flies. And when you combine that with the fact that remote work is more popular than ever, and you don't have as many people in the office as before, the values of these buildings are just not there, guys. Recently, we've seen story after story of people that own these big commercial buildings that are handing the keys back to the bank because they are not able to refinance it, and the building is now worth less than they paid for it 5, 6, 7 years ago in many cases. And the question is right now is this commercial real estate crash going to be a big enough problem to affect the entire economy? Because I think that's a kind of an unknown, right? We don't know to what extent this is going to really hurt the rest of the economy, right? We know that it means that businesses are going to close and people will lose jobs from this, but to what extent is yet to be seen. And also, the other side of it is small and medium-sized banks are the ones that hold the majority of these commercial real estate loans. And when the owners of these buildings start defaulting on these loans, they're going to have to foreclose on these buildings and try to turn around and sell it to recover their money. Problem is, they're not going to recover the money because the amount that was borrowed on these buildings 5, 6, 7 years ago is much higher than what they're going to be able to sell them for today. So these small banks are going to be taking massive losses, which is no doubt going to cause more trouble with the banking industry. Something else that's going to have a major impact on the economy, AI. We haven't even fully seen yet what the impacts of AI are going to be on their future economy because this is so new, guys. We don't know what's going to happen yet. And you know, one of the biggest unknowns of where things are going to go into the future is actually uncertainty itself. Like, that's always a thing. People can never really predict the future and what's going to happen. But because we just came out of this crazy pandemic and this unprecedented situation with more money than ever injected into our economy, these crazy run-ups in home prices and the stock market, basically the everything bubble, there's a lot of uncertainty surrounding what's going to happen with that, you know? There's some people on the one side of the argument that say that this is going to continue going higher and higher forever. And then you got people like me that think the more realistic outcome is that things are going to drop back to their historical mean at some point. That's what I think is going to happen. And I'm not sure how much most people realize that they're taking on just a tremendous amount of risk right now just by being invested in the stock market or continuing to trying to flip houses or continuing to try to, you know, expand an Airbnb empire. These risky sort of business ventures that work well when the economy is balanced could pose a huge threat to people later down the road when this bubble bursts, in my opinion. Here we have a waterfront house for sale for $4.35 million. And you know, I'm so glad I run across these listings because it's such a nice free form of entertainment for us. Well, look at this. They bought it back in 2020 for $1.786 million, listed it for rent for $9,000 a month, shot the price up a month later straight up to $35,000 a month, kept cutting the price all the way down to $14,000 a month for rent, never rented it, canceled the listing. Then they decided to try again, listed back for rent again for $14,000 a month, increased the price to $15,000, increased it up to $30,000, then dropped it down to $28,500. They actually got a contract at some point, fell through, they never actually rented the house, and that brings us right to present day where they decided, you know what, we're just going to sell it instead, but we're going to put a huge price tag on it, so I'm sure that's going to work out just as well as the rental situation did. Probably just going to be sitting here empty. All these houses just hemorrhaging money here in Miami is a complete joke, and guess what, their property tax bill is close to $40,000 a year, so yeah, they're choking on that as well. I think people just need to realize right now that coming into 2024, maybe 2025, is when business is going to slow down on a lot of things, guys, because we are going to hit this recession, you know? When the yield curve gets uninverted, when the Fed actually starts cutting rates, a couple of things always happen, historically speaking. We always see unemployment go up, and we always see a recession. The question really isn't if it's going to happen again this time, it's just how bad is it going to be this time, you know? And I think that's the big thing that a lot of people are kind of missing right now and maybe avoiding on purpose or just because they don't know, because they don't pay attention to history. But this has happened every single time in the past, and there's no reason to think it's not going to happen again this time. But it seems like there are a healthy amount of people out there that actually think somehow this time it's going to be different. Well, when we talk about inflation, we could see a resurgence of inflation in 2024. A couple of things that the Fed really needs to pay attention to are the inflation in services, okay? because inflation for goods has been coming down. However, for services, it is not. And that is the problem right now, because when you look at this chart here, it shows you inflation on goods versus services, okay? And the purple line is goods that actually shot up far higher than services ever did during the pandemic, and has since come down and is basically flat. It's not really going up. But as you will also notice, the blue line is services that did go up during the pandemic, not as sharply, but it's also not coming down, and it's actually starting to creep back up again. Now, part of the reason this is happening is because of a shift in the way people are spending money. If you think about it, when people were sitting at home during the pandemic, locked up, you're buying a bunch of goods, you're not really out paying for services because a lot of things were closed, people weren't going anywhere. But after all that ended and all the lockdowns were lifted, people decided to go back out and start paying for services again, like travel and entertainment and dining out and things like that. Those are services. And so the big problem is because the demand for services has basically surged, businesses could not hire people fast enough. And also these businesses have to pay more to attract people because of the massive overnight demand for all these service businesses. So as a result of this, the inflation for service-based businesses has been far stickier. And this is something that the Fed is definitely going to be watching. There's also other big parts of service businesses that are costing us a fortune right now too. Most notably car insurance. I'm sure everybody's been feeling the increase of that. I talked to my dad the other day in Illinois. He got an increase in car insurance as well. It's not just a Florida problem, guys. Like, I had this huge increase in insurance, which I'll talk about in another video if you guys want me to make a video about that. You also have repair costs for cars up 13%, higher than they were a year ago. Even streaming costs have gone up. They say only 5%, but I would be willing to bet that the cost for streaming has gone up by more than 5%, because I've seen how much they have increased the prices on a lot of these streaming services lately, and it seems like by more than 5%. So we still have this massive inflationary pressure on the service side of the economy that is actually starting to resurge and go back up. And this is going to be a huge problem for the Fed in 2024, especially since they're talking about interest rate cuts already. And the Fed is also banking on the fact that shelter costs is going to continue to go down in the CPI numbers because it has been falling. But if it doesn't continue to fall as much as they think it will, then they might have to rethink their strategy in 2024 of cutting all these rates. They say another big factor of inflation right now too on the service side of things is the rising cost of medical care and health care. And you know, I'm sure a lot of younger people like me don't feel this, but if you're older and you need to go to the doctor a lot, you're probably definitely feeling this right now with the cost of prescription drugs going up, the cost of copays going up, all of this. Like, I just renewed my health insurance, guys. Like, all my copays for the year next year basically doubled. You know, nothing changed on my end. I'm still the same guy. I haven't had, you know, big problems. I haven't had to, you know, be admitted to the hospital or anything, but yet I got to pay more, you know? So one of the ways that the Fed hopes to achieve lowering inflation is by increasing unemployment, guys. That's what a lot of people keep forgetting. You know, everybody's excited about these rate cuts coming in 2024. Everyone's forgetting that one of the ways they plan to achieve lower inflation is through higher unemployment, because when people don't have jobs, they can't pay for all these goods and services. And that naturally helps inflation come down, but people suffer as a result. Now, I haven't covered any international stories in a long time, but I wanted to cover this since it's related to real estate, and that is that in London, England, the home prices there have now seen the biggest fall on record since the 2009 housing market crash. In London, England, as of October of 2023, home prices there have dropped 3.6%, which is the largest drop that they've seen since 2009. And they're saying that the reason for this is because of the higher interest rates that the Bank of England has imposed on the people of England. Also, they are showing a big drop in the amount of home sales there as well. In fact, down 21% year over year. So it sounds a lot like the situation here in the US. The biggest difference is we haven't seen that big decline in home prices nationwide. However, we have seen it in certain cities, guys. You know, it just kind of makes me laugh a little bit when I see that people see this and they say, oh, this is no big deal because prices just went up way too much. So who cares if it went down by 3% here or 6% over there or whatever. I even saw this in the comments section of the video I made recently about, you know, where prices are coming down in Florida and how much inventory is exploding in different areas. And it's just funny to watch people brush it off because it shows their level of ignorance of how much they just don't know about real estate and the economy. But people like that are just going to have to learn the hard way that this is just the beginning of a very long, drawn out downfall. And that's how it happens. This is how it happened before and gives us a lot of reason to think this is how it's going to happen again. And to just prove my point a little bit further here, one thing I mentioned earlier is the inverted yield curve and how every time we have this, it's followed by a recession, right? That's a historical fact. It's not Michael Bordonero's opinion. Well, right now, because the yield curve is so inverted, guys, this is how much it messes with the economy, okay? If you want to get an adjustable rate mortgage right now, it is actually more expensive than getting a 30-year fixed mortgage, which is unheard of. That's how inverted the yield curve is and how much of an impact it's having on our economy right now. When you look at this graph right here, the red line is the 5/1 adjustable rate mortgage and the blue line is a 30-year fixed mortgage. And as you can see, almost always the 30-year fixed mortgages are more expensive than adjustable rate mortgages. As of recently, that's not the case anymore. If you want to get a 30-year fixed rate right now, you're looking at around 6.7, 6.8%. But if you want to get an adjustable rate mortgage, it is closer to 7%. Not only does this completely get rid of the need to even get an adjustable rate mortgage, it's kind of like the whole reason to get it is because it's cheaper in the beginning, right? It saves you money on interest for the first few years, and the idea is that you will refinance when rates come down before the rate adjusts. And they talked to a lender here and they said that people still always ask about adjustable rate mortgages even to this day. Is it cheaper? You know, should I get one? Because people are looking to have the lowest possible payment, guys. Nobody cares about what the consequences of this might be later down the road. They just want the lowest payment. They'll deal with it later is pretty much the mentality. Only once the Fed starts cutting rates is this actually going to change. That's when you're going to see adjustable rate mortgages become cheaper than 30-year rates again. However, that's the problem, guys. Everybody wants to get these lower interest rates, right? But everybody keeps forgetting the fact that when we get these lower interest rates, it's going to coincide with a massive recession. And it's not like adjustable rate mortgages are as prevalent as they were back during the last housing crash. No. In 2023, adjustable rate mortgages made up of only 7% of all of the mortgages versus during the 2008 financial crisis, it was as high as 30%, guys. So a big difference between how many people are getting these adjustable rate mortgages compared to, you know, back in the day when we had the housing crash. But we don't need that this time because now we have inflation and we have an inverted yield curve that we didn't have last time. So now what we have to contend with is the inevitable, which is going to be rising unemployment and a recession. And I think just because of the fact that this recession has been delayed for so long, you know, this is a massive recession that we should have had whenever the pandemic began. They kind of shut down the world economy. And since that was delayed and boosted by all of the pandemic stimulus, that all of that money is gone and now it's all been pretty much used up and injected into the economy and prices have gotten to bubble levels that cannot be sustained. This is where things are going to start to correct. So basically my theory here is on this channel is that things have already gotten as good as it can get, so to speak, with the economy, with how much all these asset prices have gone up and all of this, that the only way for things to continue from here is for it to correct back downwards, back to its historical mean, guys, because that's what always happens throughout the past, and I don't have any reason to think that that's not what's going to happen again this time. The only thing that some people mention that could change that dynamic is if inflation runs away and gets even further out of control, and we basically have runaway or hyperinflation, the price of assets like the stock market and real estate that we see today could actually remain the same or move higher in that environment, because it's not actually the price of those assets that's going up, it's that inflation gets so bad that the value of our money has been eroded so much that it looks like the price is going up nominally, but when adjusted for inflation, it's still actually going down. That is the one argument that I think actually holds a lot of weight in terms of continuing to see prices of things go up. But if that's the case, guys, we're going to have a whole new set of problems other than the fact that asset prices are up, because everything else is going to go up so much that the average person isn't going to be able to afford it, and that's going to cause a whole new set of problems that we're not going to get into in this video. So if you guys enjoyed this video, make sure you subscribe to the channel, and if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.